Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shauna Smith. Let's get you up to speed on the market action with 1 hour left to go in the trading day. It is red across the board right now. The Dow down nearly 300 points. The S&P 500 down 38. The Nasdaq down 105. Those declines we're seeing today, despite better than expected economic data that came out this morning with retail sales coming in higher than expected. That increased about 0.7% month on month. But we are seeing, when you look at sectors, energy seeing the steepest declines today. We did see oil just hovering around that $80 a barrel mark. Some of that coming through because of that China data that we got out today, Shauna.
Yeah, Kiko, let's start right there with China and the latest that we're getting out of China. Its central bank cutting policy rates for the second time in 3 months in an effort to boost its struggling economy. Reports out on retail sales and factory output also missing expectations, and the country saying that it will no longer report youth unemployment after months of increases. For more on that, we want to bring in Charlie Vest, Associate Director of the Rhodium Group. Charlie, it's great to see you here. So China ramping up its easing efforts. We have some more concerning economic data coming out today. How much trouble is China's economy in?
Thanks for having me. Yeah, the Chinese economy is definitely under a significant amount of stress right now. The key thing to watch here is the real estate sector. This has been now the 28th month of declines in new construction activity in the real estate sector. That puts China's overall construction activity down by over half since it reached its peak in middle of 2021. And that has a big impact across the economy, not least on local governments who have relied on land sales to balance their books for years and are now under a considerable amount of stress.
Yeah, I mean, when you look at the real estate sector, the numbers that we got from Country Garden sort of reigniting those concerns again this week. In the past, when we have seen a slowdown in China, we have seen the stimulus come through, not just through rate cuts, but also incredible spending in the real estate sector, racking up debt. How does this time look different?
The challenge that China is facing now is that the room to continue this sort of debt-driven growth model is much weaker than in the past. You know, banks have a large share of unrecognized bad debt on their books, and that's constrained their profitability in ways that the data doesn't necessarily show. And so banks aren't able to sort of continue to push a lot of money out into the system. And that's really what the sort of core of the issue is right now. What we are sort of looking for is potential signs of consumer side stimulus to help with the sort of malaise in retail spending, as well as a looming restructuring of local government debt.
Charlie, is the worst yet to come?
I'd say we're nearing the bottom. Our estimate, around mid-2021 when the real estate market hit its peak, there was around 1.5 billion square meters annualized of real estate, residential real estate construction activity. And our view at that time was that, a sustainable level of construction in the real estate sector was around 550 to 750 million square meters a year. And that's just based off of demographics and family formation. We're reaching the point now where last month it was around 750 million square meters annualized. We're reaching the point where the real estate market might start to bottom out and start to see a flattening of that. The issue is, though, that China's economy really did rely on real estate growth for many years to drive growth, and even when it does bottom out, it's going to be at a much lower level activity in the past. We're not going back to the real estate go-go years of 5 or 10 years ago.
So what does that mean overall in terms of the growth picture? I mean, we were looking at 5% this year. Does it look like they'll hit that target, or are we talking just below that?
I think we're probably looking at below that. If you break down growth into its constituent factors, thinking about consumption from households, consumption from government, investment, and net exports, really the only thing that's going to be driving growth in 2023 is the sort of modest recovery from the consumer side. So yeah, we're expecting much lower growth than the around 5% target that the government set earlier this year.
Charlie, it's never a good sign when you've got a government that says we're not necessarily going to report this data right now because of methodology. That's what happened today when we got that announcement on youth unemployment. We know it's been upwards of 20% for some time. What does that tell you about how the government's looking at that number and how significant that is?
Yeah. So the last number we had from, I guess it was June, was 21.3% unemployment for folks aged between 16 and 24. And in this past data release, they didn't include that number. It's gotten a lot of negative press attention, or just press attention in general, as a signal of the performance of the economy. So it's not, in a way, it's not surprising that the Chinese government decided not to report that number, especially because in July and August, we're likely to see a spike in that number from recent graduates who are now on the job market and still haven't found a job yet. I think the more concerning thing is this fits in a pattern of discontinued data series and general data transparency issues that make it hard for folks like us to really present a clear picture about what's going on in the Chinese economy more generally.
Yeah, Charlie, this move right there, restricting access here to another key data point. How unnerving is this when we're trying to best gauge what the situation is in the world's second largest economy?
It certainly makes it more challenging. There are ways that you can track the performance of the Chinese economy with more reliable figures. But that's also, those very numbers are leading us to be very concerned about the state of the economy. One of the best metrics to understand how fast China's economy is growing in real terms is the credit growth. So total social financing is a measure of how much credit is flowing in the Chinese economy. That growth rate hit 8.9% last month, which is the lowest on record.
So connect the dots for us. We're talking about the world's second largest economy. We saw oil, for example, down today on concerns about the demand coming out of China. When you look at the economic picture and the slowdown that is happening in China, what are the ripple effects you're looking at?
Sure. So yeah, the renminbi is under a considerable amount of pressure, both from these negative sort of bad reporting and from general capital outflows that have been happening throughout these past few months as China has reduced rates and there's been weaker foreign investment into the economy, and that's putting pressure on the renminbi. The PBOC has sought to defend the renminbi at around 7.3. which is a natural place for it to defend, since that's about the lowest that it got over the past decade, going back to like 2007. And I expect we'll continue to defend at that level, but persistent weak renminbi is going to affect the price of China's exports. It's going to affect China's imports, and it's going to affect the commodity markets that so many developing countries that export commodities to China. That's going to affect their bottom line.
Certainly global implications that we'll continue to follow here. Charlie Vest, Associate Director of the Rhodium Group. Thanks so much.
Thanks for having me.
Let's turn our attention to some stocks we're watching today. Home Depot kicking off a big week of retail earnings this morning. The retailer beat expectations on the top and bottom line, but same-store sales saw a third straight quarter of declines. You see shares up just slightly. There, a number of interesting comments coming out of this earnings call, Shauna. And again, we talk about retail. It's a good gauge of where the consumer is right now. The CFO of Home Depot saying we don't expect to see meaningful inflation in the second half of the year. The retailer itself has also lowered some prices, and sort of what we've been hearing for so many retailers, which is that the consumer is turning more cautious, especially when it comes to larger ticket items. And we saw that reflected in the quarterly results today. Yeah, we saw it reflected in the quarterly results. They were also asked about that on the earnings call, and Home Depot giving a little bit more color on that, saying that the big ticket transactions, that's those over $1,000, that was down 5.5% compared to the second quarter of last year. So some weakness there. You mentioned the declining same-store sales that we saw again the third quarter in a row. It wasn't as big of a drop as the street had been bracing for. So yes, that is a bit of good news. But the street also looking at the fact that Home Depot did not raise its full year guidance when it came to same-store sales, really reiterated what they're expecting to see, a drop between 2% and 5%, as some cause here for concern. Lowe's, which is reporting next week, its competitor there, their shares edged a bit lower on the heels of this report shortly after the open. But when it comes to analyst reaction here, obviously that guidance, one of the big reasons that we're seeing some caution here from the street. Evercore's Greg Mellick was out saying that some might be disappointed in that guidance, and also that continued pressure in certain big ticket items. So we are seeing consumers
really restrict their budgets, forced to make some of these tough decisions, and they're not willing to spend on some of those items that cost more than $1,000. So it shouldn't be a surprise at this point in the economic, or this point in the global economy or U.S. economy right now. Kiko, let's take a look at regional banks, because we're also seeing some movement there. Those stocks under pressure today, falling into the red after Minneapolis Fed President Neel Kashkari warned that the banking crisis may not be over. He also went on to say that proposals for stricter capital requirements for banks with more than $100 billion in assets doesn't go far enough. So we're seeing some of those jitters across the board when it comes to some of those regional plays. Kashkari, the fact that he was saying that we do see higher rates, he didn't commit. He didn't say we necessarily need another rate hike here from the Fed, but he did say if we do see another rate hike, that is what could cause a little bit more distress and a little bit more concern within some of these smaller lenders.
Yeah, when you talk about the path of rate hikes, so what he essentially said is we're a long ways away from a rate cut. That's as far as the commitment went. But going back to what we've been hearing on regional banks, he's referring to, of course, the proposal that came out from regulators for additional capital requirements. We're talking about mid-sized regional banks. It would be about 5% additional requirements there. And Kashkari's direct words here, he says the risk is that if inflation is not completely under control, that we have to raise rates further from there to bring it down. That they, as in the regional banks, might face more losses than they currently face today, and those pressures could flare up again in the future. Now, this, of course, came on the back of a headline we got this morning about Fitch warning it may have to downgrade the credit rating of some of these the larger banks as well. But certainly, anytime you hear about concerns about those capital requirements, certainly things flaring up even months after the collapse of Silicon Valley Bank.
Yeah, certainly. We're seeing that those jitters reflected in the stock prices today. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, tensions rise between the United Auto Workers Union and the auto giants, with the UAW set to vote next week on whether to strike. Plus, a grand jury in Georgia has indicted former President Donald Trump as part of an investigation into his efforts to overturn the 2020 election. We will break down the charges and 2024 implications. And President Biden touting the one-year anniversary of the Inflation Reduction Act. We discuss the law's impact and much more when Yahoo Finance returns. Tesla is unveiling cheaper versions of its Model S and Model X electric vehicles. Yahoo Finance's Pras Subramanian has the details for us. Pras.
Hey, Shauna. So yeah, Tesla are making those higher end cars more affordable here, adding a standard range version to both the Model S and Model X SUV, cutting those prices by $10,000 here. So now for the Model S sedan, that standard range version, it's going to cost $78,500, but range drops to 320 from 405. Now for the Model X standard version, that's the SUV, price comes down to 88,500, but range slips to 269 from 348. So these are some big, almost 20% sort of drops in range. But here's the wrinkle though. EV Blog Electric confirmed that Tesla isn't using a smaller battery to actually decrease range. They're actually doing it by software using a range lock via software. So it's very odd because you would think Tesla would kind of accrue a cost benefit by using a smaller battery. Instead, it's the same battery that appears in the regular versions of the car. It's a possibility that, and Tesla did not confirm this, that they could actually maybe offer the ability to unlock extra range for a fee. So that could be a value add there for the company to get more profits there by unlocking that feature.
Pras, on the charging front, we've seen a long list of companies adopting Tesla's charging standard. Who's the latest now?
Kiko, it's Fisker. They're joining the party, the Tesla Supercharger party. However, they will only gain access in 2025 the use of an adapter. And sometime after that, Fisker says they'll include that NACS port, that Tesla port, natively in their car. So I asked Fisker why 2024 wasn't an option like the other Tesla partners. They haven't gotten back to me yet, but I think that's really interesting there. Maybe it's a cost or sort of strategic initiative there. But still great news if you're an Fisker EV owner. Earlier this month, Fisker had that product vision day. Kiko, you were there. You spoke to Henrik Fisker himself and saw the new pair crossover, the Alaska pickup, and the Ronin supercar. And I have to ask you, Kiko, what did you think of the Ronin and also the Alaska pickup?
I mean, the Ronin range is the one thing that stood out to me. The price tag, $385,000. And then a range of more than 600 miles. Did I get that right?
Yeah, I mean, we'll see if that actually happens. But I think that a lot of people ask me about the Alaska pickup. So we'll see. A lot of good things going on for Fisker at the moment. And this charging deal definitely helps them out with more buyer opt-in, I think.
Sorry, did you guys say $385,000?
Yeah, I think it might be even more too, right?
Oh my goodness. Talk about an expensive car, right? Pras, thanks so much.
Thank you.
Well, shares of Vietnamese EV maker VinFast making a big splash in its Nasdaq debut. The stock trading under ticker VFS getting a pop up more than 35% after opening at $22 a share. The listing through a SPAC merger comes after the car maker delayed plans for a traditional IPO last year. The firm, founded 6 years ago as part of Vietnam's largest conglomerate, Vingroup. The company started producing electric vehicles in 2021 and currently has 4 models in production, with 2 more on the way. Let's bring in VinFast CEO Thuy Le. Madam Thuy, it's good to talk to you today. Congratulations on the listing. This feels like a long time coming, considering that you had to delay the initial IPO listing. You said you came to market through a SPAC because you wanted it to happen now. Why was the timing so important?
First of all, thank you very much to have me here today. It's a very exciting day for VinFast because we're very thrilled that we reached the milestone of getting the company listed in the US. This is the goal that we've been working toward for the last 2 years. So we achieved it today. The listing of VinFast on the stock exchange in the US is important because it's another milestone to become a global company. So this is an important day for us.
Yeah, the big step you're taking as a global company here in the U.S., you've already broken ground on that plant over in North Carolina, the first manufacturing plant for VinFast outside of Vietnam. Why compete in the U.S. market?
We think that the U.S. market has a lot of opportunities, and with the wide range of vehicles, from the small vehicles like VF3 to the big 3-rows large size SUV like VF9, we feel like we have a whole lineup of vehicles to make EVs accessible to everyone. So building the sustainable mobility the green mobility is our mission.
With that said, you're coming into a very crowded market dominated by Tesla, but of course you've got a lot of companies coming in, whether that is GM, Ford, Rivian. I mean, there's a long list here. What does VinFast have to offer that this market currently doesn't have?
We think that if you take the view that the whole world is moving from internal combustion engines to EVs, and there are not enough EV models to meet all the market segments, it's actually there's still a lot of room for new player like us, with the wide range of EVs that fit different segments on the market. We believe that there's an opportunity for us here.
You've got an interesting model that has really taken shape over in Asia, which is a battery subscription model. Essentially, you take out the price of the battery and then allow the drivers to buy the battery, or at least lease the battery on subscription for a monthly fee. Is the plan to introduce that in the US as well? Because I know that that's kind of shifted over the course, or at least on the road to this listing.
Yeah, we started out with the battery leasing model in Vietnam as well as in international markets. And we're still doing that in Vietnam today. Like you rightly pointed out, that it makes transition to EVs a lot easier by bringing down the upfront cost. However, it's in certain markets like the US, it's more developed, and there's challenges with getting financing to the consumer using that model. So we're still using it, but most of the sales has been on the model where the battery is attached to the vehicle.
That model for battery subscription, battery swapping, though, is that something that you think could take hold in North America? We've seen it popularized over in China, but hasn't necessarily hit the market here in the US.
Yeah, the market in the US, I mean, where you have financing for vehicles very, very developed, the model might not be as popular as in the markets like in Vietnam, where financing, consumer financing for the vehicle is not as developed. And also, I think we try to make that model work with some of the banking partners here in the US, but we also face some challenges with implementing the model.
We have seen, in terms of your financials, widening losses as you look to invest and expand this footprint. The chairman of your parent company, Vin Group, has said that he expects VinFast to be profitable by 2025 if things run smoothly. What does that path to profitability look like?
I think we're on track to achieve the plan that we set out for. I mean, we have invested a lot. I mean, so far, our shareholders have invested almost $10 billion into the company. We got the commitment of $2.5 billion more from Vin Group and our chairman. And we have made significant investment in the company in order to get to the whole lineup of vehicles that we have, the facility in Vietnam, now the manufacturing facility here in North Carolina. So we believe that with all the investments and the strategy that we have pursued, we are on the right path to profitability.
VinFast CEO Thuy Le, it's good to talk to you today. I really appreciate you joining us from the Nasdaq.
Thank you so much for your time. Thank you.
We are switching gears and checking in on what's happening in the auto space with less than a month before the UAW strike deadline. The United Auto Workers will hold a strike authorization vote next week. It's a procedural step union leaders need to take before calling for a strike. The news comes about 1 month before the existing contract between the UAW and the big three car makers, Ford, GM, and Stellantis, expires. We're going to talk about that on the other side of the break. We'll be right back.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
The United Auto Workers will hold a strike authorization vote next week. It's a procedural step union leaders need to take before members can strike. The news comes about 1 month before the existing contract between the UAW and the big 3 car makers, Ford, GM, and Stellantis, expires. President Biden weighing in on the talks yesterday, writing in a statement, quote, "I'm asking all sides to work together to forge a fair agreement." And that transitions are, quote, fair and look to retool, reboot, and rehire in the same factories and communities at comparable wages. Here to dig into this and more in the car space, let's bring in Tom Narayan, RBC Capital Markets Lead Global Autos Analyst. Also with us, David Weston, Morningstar U.S. Autos Equity Strategist. Great to have both of you here today. Tom, regardless of whether there is a strike or not, this all points to cost increases for these car companies. You look at what UAW is asking for, a 40% increase in wages. How do you think investors should be looking at this in terms of the financial impact to car makers?
Yeah, it's no doubt it's catching a lot of headline interests, and there will probably be some cost inflation. But you have to remember the auto industry, especially the car makers, are enjoying record level pricing and profitability so far. That pricing is probably going to normalize. That's a bigger threat, I think, to the auto industry than this one-time hit that'll happen with the strike or financial costs raising somewhat. Remember what happened in 2019? That strike had a big hit in 1 quarter, and then there was a sharp snapback afterwards. So I think investors are, for the most part, looking at it and monitoring it, but they're really looking past it into 2024. The big topic really for the car makers is pricing and price normalization. That's going to have a much bigger impact.
Dave, let's stick with the UAW, the strike there, before we get into pricing. From your perspective, how big of a hit, if we do see a strike, could that be to the automakers? And if we don't see a strike, if we do see the automakers concede to some of these demands from the union, what's the impact then?
Yeah, well, the latter part of your question is the massive unknown, because right now the sides are just so far apart that I mean, this is my 5th round of contract talks in my time here, and This is the most worried I've been about any of them because of the gap in the gap to getting an agreement. But what the union's asking for is to really go back to how things were in the 20th century with everyone having a pension and retiree health care. And I understand the union's perspective on wanting to do that. Many of those workers have seen their parents or their grandparents have those benefits, but it's just not economically feasible anymore. So you'd be talking tens and tens of billions of pension liability. I don't think the management teams are willing to do that even with a strike. And then the wage part, I think they can afford to do that. It's the pay raises I'm not as worried about. It's all the extra things that go with it, like a 32-hour work week, for example. That means you'd have to hire more people to keep the plants going. It just doesn't make any sense economically.
David, on that point, I'm curious about what these latest negotiations could do in terms of the footprint, if we're talking about the big three in Detroit. I mean, we have seen other car makers move to more non-union markets like South Carolina. Is that the general trend where things are going because of those cost issues?
It's the general trend for everybody generally, except the Detroit three, because I think wherever they go in the United States, they're going to have union representation. Take Ford with their new Blue Oval City complex being built in Tennessee. I would fully expect that to be unionized. You've even seen some of the battery JVs, like GM's Ultium JV plant in Ohio. They voted to join the UAW late last year. Everyone else, you've seen Elon tweeting about the UAW in the past. He's clearly not interested in having the UAW represent his workforce. But with the Detroit three, I don't see that changing. It's just a matter of where does the headcount go. What GM has been saying in terms of the shift to EVs is that you need the same number of people to build these cars, whether it's EV or ICE. Then it's just a matter of natural attrition.
Tom, let's talk a little bit more about pricing, the issue that you brought up earlier. When you come to the fact that so many of these automakers are under a tremendous amount of pressure to lower the pricing of their vehicles, given what their rivals, what their competitors are doing. And we also had the news out today that Tesla's rolling out lower priced options for the Model S and Model X. How do you see these price wars playing out and how big of a drag this could potentially be for the larger automakers?
Yeah, I think this is really the more important issue versus UAW. I think that's more near term. And so it's going to be a tremendous impact, I think, to near term 2024, possibly 2025 numbers, that they're not really in people like me. They're not in our estimates. And I think it could be really scary. The one thing I will say, though, is I think EVs, thanks to all of the money coming from the federal government, you mentioned, GM earlier with Ultium. There's a lot of money coming down from the federal government, from the IRA, that's going to subsidize the D3 and automakers in the U.S. to produce cells domestically, and a $7,500 credit per car to do so. You're going to see a lot of price deflation, actually, I think, on EVs the next few years. It's going to be cheaper to buy an EV than it is to buy an ICE. That's how the government wants to entice people to buy EVs here in the U.S. And it actually might wind up being a financial windfall for the automakers here in the U.S. because they're going to be able to produce these EVs cheaper than when they would be able to produce the ICEs, thanks to all of this money coming from the federal government. So I actually think even though near term there could be some problems with pricing coming down, longer term, thanks to the IRA, that might actually subsidize a lot of these price cuts. And we, the consumers, probably going to be the net beneficiaries.
David, you agree with that? Higher volume but lower price tag as a result of those federal incentives coming through?
Yeah, and I agree the consumer ultimately is going to benefit because there is, of the IRA, there's a lot of taxpayer money to help out with this. And you're already seeing that with when Tesla started with the initial 20% price cut on the Model Y, and then they've kept going with that with further cuts. There are people that probably would have normally bought a combustion model this year. Instead, they're like, you know what, I'm going to go electric and get that Model Y. And the Model Y is driving a huge chunk of the EV market share gains in the U.S. And then on pricing versus volume, yeah, I think everyone's been, this pricing risk thing, it's been going on all year, late last year. There's been so much fear about pricing, and the pricing downside hasn't happened in 2023. And I think people are neglecting that volume side too. I mean, remember how bad things have gotten in 2020 and 2021. Inventory is still at about, it's just under 1.8 million units now. Before the pandemic, it was 3.5 to 4.1 million units. We're not probably going back to pre-pandemic inventory levels, but we're not staying below 2 million either. So don't You've seen this with the suppliers' earnings this quarter. Don't underestimate the impact of higher volumes, because it does matter even if you have pricing declines. And pricing's not going to collapse like everyone's thinking it is either.
Tom, on the point about the IRA, obviously the price tag lower, but also what we have seen is maybe a year ago when the IRA first passed, there were a lot of car makers who were a little skeptical of how some of these cars would qualify for that $7,500 credit. How much of the sourcing was from North America, where it was manufactured. A year later, to what extent has the IRA shifted the manufacturing footprint for some of these car makers? I mean, are we seeing a wholesale rethink of where these cars are going to be manufactured just so they can tap into those incentives?
Yes, 100%. We actually hosted a factory visit to Ultium's GM Ultium's first facility in Ohio last week. And I can tell you the IRA is a prime reason why they're doing it. $2.6 billion for each facility. They're making back $35 per kilowatt hour as a credit for the cell, $7,500 you mentioned for the price of the car. A Chevy Equinox could be sold retail pre-credit for $30,000. You and I could get it for $20,000 at the same profitability. We heard Stellantis is building in Indiana. Ford noted where they're building in the U.S. as well. So everybody needs to build the cells locally in North America to qualify to get the $7,500 and the $35 credit too, which completely more than offsets that capital expense, the $2.6 billion per plant that GM is doing, totally offset by the federal government. It's like I think it's a total like $1 trillion shift from the federal government to the auto industry and the consumer. So all of these OEMs are trying to jump on this and capture, and we're seeing that momentum already take place.
Yeah, it's been interesting to see how the IRA has taken hold in the EV space. RBC's Tom Narayan and Morningstar's David Whiston. Good to talk to both of you today. Appreciate the time.
Former President Donald Trump indicted for the fourth time, this time for his efforts to overturn the 2020 election. A Georgia grand jury has charged Trump with racketeering and a number of conspiracy charges in the 41-count indictment. Here to break it all down, Yahoo Finance's Alexis Keenan, as well as Rick Newman. Alexis, let me go to you first for the legal perspective of all this. Break down the charges that former President Trump is facing.
Okay, so this is a state case. It is brought by state prosecutors, and that makes it a little bit different from the other case that is also arising from actions allegedly to overturn the 2020 election. Makes it different from that federal case that was filed a couple of weeks ago. Now, these new charges are against Trump along with 18 other defendants. They say that they violated state laws by pressuring elected officials to alter the vote count, also by making false claims regarding the vote. You can remember back when Trump was tweeting a lot about that. Some of those claims are in there. Also, some of these defendants, they include Trump's former White House chief of staff, Mark Meadows, Trump attorneys, Rudy Giuliani, John Eastman, Sidney Powell. The complaint here, the indictment rather, it contains 41 crimes in total alleged. 13 of those are against former President Trump. All of the defendants are facing racketeering charges, and that charge alone carries a maximum of 20 years in prison. There are other charges wrapped up in this indictment against the various defendants. Those include conspiracy, soliciting public officers, officials, false statements, impersonating public officers, also forgery, false document filings, as well as attempting to influence various witnesses. These new charges, of course, stack on top of the 3 additional indictments that have been handed down against Trump and others over the course of the last 4 months or so. You have the case in D.C. that I mentioned previously against Trump and 6 co-conspirators. You also have the federal case in Florida alleging that Trump had retained classified documents after having left office. And then on top of that, you have the state charges in New York that allege that Trump had falsified documents related to hush money payments to the adult film star Stormy Daniels. So a lot to think about here.
Yeah, I mean, Alexis, so we're talking about 4 indictments just over a year out from the presidential election. What does the timeline for these trials look like?
Yeah, so the first one, Akiko, is in March. And so that starts to get into primary territory. Then over the course of these 4 cases, usually the federal cases will be set for trial about a year out from when they are filed. So that could take us all the way through the November elections and certainly creates a frustrating environment for the president to try to, on one hand, go forward with this campaign and also fight against these lawsuits and all of these charges. There are many, as you see.
Rick, when we talk about the timeline of these court cases, how much does that matter? And what are the implications here when we talk about Donald Trump trying to get elected again in 2024?
I mean, it's mind-boggling. This is completely unprecedented by orders of magnitude. So, think about the timeline elections just laid out there. Trump is probably going to be mired in criminal prosecutions for years. I mean, it's reasonable to think that this will go on long past the 2024 election date. And one thing judges can do is talk to each other and sort of sequence these trials so that you don't have one trial going on at the same time as another. So it could be one trial, then another, then another, then another. Now Trump has broadly indicated that if he gets elected president in 2014, he'll stop prosecuting himself. He will order the Justice Department to, stop the prosecutions of himself if those happen to still be underway. He can't do that with the New York City case, and he cannot do that with the Georgia case. There are so many imponderables here that it's almost impossible to predict how this will affect Trump's ability to campaign. I mean, the first thing you have to think about is just the stress on the person himself. Trump seems indefatigable and always happy to have a fight, but he's probably never faced anything like this. Second is the cost. We know this is already cutting into his political campaign funds, mostly from the super PAC where the big donations go. Some of that money, a lot of it actually, is now being put into legal defense for not just for Trump, but for many of the others indicted with him. So maybe Trump can withstand that. He gets so much media. Maybe he doesn't need the money for advertising. Maybe being in the presidential race is sort of the thing that will keep him going through all these trials. But I would be kind of surprised if a year from now, things still look the way they do today, which is that Trump is actually the candidate of the Republican Party.
So, I mean, that's the question, right, Rick? So far, these indictments appear to have only bolstered support for the president for those who are most loyal. But is there anything from a legal standpoint that could potentially disqualify him from running for president again?
No, there doesn't seem to be any way that any of this could legally disqualify him for running. But if you think about from a practical angle, it does seem plausible there could be a plea deal in at least one of these 4 cases. And I would think this would have to come within one of the 2 federal cases. That part of the plea deal is that Trump steps down as a presidential candidate and is barred from running for office again. Trump has indicated there's no way he will ever do that. But if you think about it, Trump could actually be using the fact that he's running for president as a bit of leverage. That might be something he could give prosecutors, especially if it looks like he might get convicted and actually go to jail, and it might happen before the 2024 election date. So like I said, many, many things to ponder here, and I regret to say we're going to be talking about this for a long time.
We will be talking about this for a long time. All right, Rick and Alexis, thanks.
See ya.
Well, coming up, July retail sales beating the street's expectations. It's the latest sign that a resilient consumer continues to surprise to the upside. But what's spending going to look like through the back to school and holiday seasons? We'll break it all down for you on the other side.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing. landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
The economic slowdown in China could send shockwaves into corporate America. Brad Smith is here with a closer look at some of the companies that could be hit because of their exposure to China. What do you have?
Yeah, so it's really interesting to track some of the data that has come out that has disappointed to this far. You think about some of the economic growth data that has really been lackluster to this point in time, especially in comparison to a lot of the reopening trade that once again recommenced, but in a different nation, in China, the second largest GDP or second largest economy by GDP in the world here. And that ensues an issue because you had a lot of the hopes of investors and among regulators in China hoping that that bounce back would move forward here. So just a few data points here. Let's throw out you real quick. The economic data in July, particularly here, you think about some of the industrial output failing to meet expectations, in retail sales failing to meet expectations. And then additionally here, this really pushed forward that larger concern for where growth would actually come in. If you ask Barclays, who came out this morning and cut their own GDP growth forecast to 4.5% for China, that mirrors some of what we had already heard across the street and particularly how investors are having to continue to think about this. So two ways that I want to really break this down. And one of them stems from what we still have yet to see and how one of our guests earlier had classified what is taking place in China right now. And for that, let me bring in Exante Data founder and CEO Jens Norvig, who had this to say earlier on.
When I look at the data in China, I've been covering China for about 20 years. I've never seen this type of weakness where it feels like you have a real confidence issue where the consumer is starting to get extremely nervous, worried about the future, and holding back. And it was difficult to see very clearly in the data, right? Because we had that bounce because of the reopening. But under the surface, we have a confidence issue that is very severe. And that's certainly going to have spillovers into stock markets around the world.
And so with that spillover, here's where it becomes interesting, is what is the actual policy that is going to be enacted in order to generate that demand? Well, it's kind of similar to what we've seen here in the U.S. You think about how the Fed has needed to take certain activities to ensure that people are dampening down on their amount of spending. Well, it's the opposite. What does stimulus look like in China? And that moving forward to try and spur spending. China's central bank, they've moved their lending and repurchase rates lower, putting those and particularly slashing those as the second largest economy is trying to reverse the course of its slowdown here. And then additionally, when you think about that policy vacuum, Norvig went on to say during that conversation, we are in a policy vacuum where there seems to be some internal disagreement about what should be the policy from here. And that's creating a lag and delay, and that is making markets very, very uncomfortable. Now, if you're thinking about the equity markets and some of the players that could be most notably impacted, look to some of the U.S. publicly traded companies that have the most exposure to China. Let's look at it from two frames of mind here. Tesla, Apple, Starbucks, you're seeing them on their screen. Far different companies, but still one that relies heavily on the spending propensity from the consumer in China, as they've all got growth ambitions, whether technologically in Apple's kind of handset or smartphone realm and trying to make sure that they're taking on more market share, or even in the highly competitive automotive landscape where Tesla has continued to build up its ambitions both for manufacturing and selling in China. And then additionally, you mentioned Starbucks. Some people just need to have a good cup of coffee sometimes, and that's in China too. Also here, just lastly before I leave you, if the consumer is not spending as much on physical goods, are they spending into services? That's a big question. Or is that service gambling? Now, this is something where it could be interesting. And I've been taking a look at shares of these major gambling houses or wagering houses, betting houses, however you want to look at it. It's a casino operator, folks. Wynn, Las Vegas Sands, MGM Resorts, all of these companies who have some type of experience that they have either built out in China, in Macau, or tried to cozy up to the potential gambling society or gamblers that are placing their wagers in one way or another. So if you're not spending on physical goods, maybe you're spending into services, but are you wagering your money? And that's a big question. And some investors would say, heck no.
Yeah, I don't know. The outlook for a number of those casino operators that have heavy exposure to China and also some of those retailers that do a lot of business in China, certainly headwinds, at least in the short term there for those companies. All right, Brad, thanks.
Well, consumers keep spending. Retail sales for July topped expectations as spending rose across a number of categories, including food services, clothing stores, and sporting goods. So what does this tell us about the state of the consumer? Let's bring in Tom McGee, CEO of IXIC, the International Council of Shopping Centers. He's joining us as part of Yahoo Finance's week-long special Retail Evolution, the New Era. Tom, it's good to talk to you today. You know, the word we keep hearing over and over about the consumer is cautious. And yet you look at the retail sales numbers, they came in stronger than expected. What's the mindset right now?
I think cautious is a good word. Obviously resilient for sure. Retail sales this month were strong in almost every category. As you show here on the screen, ex-auto up 1%, pretty broad-based. The things that were down were really things that, are somewhat attributable to, things that tend to follow housing and people buying homes and so forth. And so, broad-based, the retailer the consumer continues to be resilient. And when you look at things like back to school, our expectation for back to school is that, spending will increase by about 6.5%. Year over year. But the consumer is continues to be concerned about inflation. And so inflation does influence their buying decisions. That's why you see some big ticket items perhaps down year over year. But promotions, pricing, and so forth are certainly top of mind. There's a price sensitivity on the part of consumers, but they continue to spend for sure.
Tom, you mentioned the fact that you're expecting an uptick here in back to school spending. Is that because of inflation or are people buying more items?
It's a little bit of both. Our 6.5%, that would exceed the expected inflation rate. But consumers are very sensitive to inflation. 9 out of 10 of the folks that are going to buy for back to school will look for promotions. They're going to be price sensitive. They're looking for discount items that might influence the brands they buy, particularly things like apparel, and where they buy, discount stores versus luxury items. But they're still spending. One interesting thing is that you saw sporting goods sales went up in July pretty substantially year over year. And that is one of the areas that parents are spending this year is the sporting good items, because obviously when you go back to school, people start focusing on athletics as well.
So Tom, what does this mean for what we consider to be more traditional retailers, or the big box names? We have heard over and over that it's about sort of core spending. It's not about discretionary spending. We heard from Home Depot today saying that they're not going to be raising prices anymore. I mean, the pricing certainly feels like it's coming into focus more and more from a retailer standpoint because of how cautious the consumer is turning.
Yeah, certainly discount retailers are in vogue right now. I mean, that consumers are price sensitive, and so they are drawing large crowds. When you look at somebody like Home Depot, some of that has to do with what's happening in the housing market as well, because they're somewhat housing dependent. But discount retail, things like Target, Walmart, et cetera, are going to do well in this environment where consumers are continuing to spend, but they're price conscious. And so they're going to look to retailers that offer discounts.
Tom, from the shopping center perspective, what are you seeing in terms of occupancy rates? And given the fact that we are in a very uncertain economic environment right now, how is the industry, how are retailers positioned?
Yeah, suburban retail is on fire right now. So, the work from home phenomenon has clearly benefited suburban retail. People are working from home more often, they have more free time. So they're shopping more, both traditional retail shopping and going out to eat at local food and beverage. Urban retail is challenged, and it's challenged because of, again, the contrast from working from home is not going into the office. And so the strain on the office market has impacted urban retail. But the vast majority of retail space is in the suburbs. And so occupancy across the industry is almost 93%. It's very, very strong. And so that's doing very well. And stores are being used not just for traditional shopping, but retailers are increasingly using their stores for fulfillment, as many fulfillment centers. So solving for that last mile, either shipping from stores or having customers come in to fulfill online orders. So you're seeing retail, the use of physical retail really have multiple dimensions now beyond just traditional shopping.
And adapt to the new environment that we're in. All right, Tom McGee, IXIC CEO, thanks for joining.
Thank you.
All right, well, coming up, the closing bell on Wall Street, we're going to check in on some of the latest market moves of the Dow, S&P, and Nasdaq, still in the red, all off just about 1%. We'll be right back. That's the closing bell on Wall Street. Let's do a check of the markets. All three of the major averages closing in the red. Weak data out of China. Also some concerns around the banking sector weighing on investor sentiment today. You're looking at the Dow closing off just around 360 points. The S&P off just over 1%, as well as the Nasdaq. All 11 of the S&P sectors closing in the red. Energy, financials, consumer discretionary, materials among the worst performers in today's trading action. All right, let's check in on some of the top movers of the day. First up, taking a look at shares of Home Depot closing just above the flat line after the company saw sales fall 2% compared to a year ago, driven lower by a decrease in transaction growth. The company also reaffirming its guidance that it set last quarter, expecting a drop in sales and adjusted earnings for the full year as consumers remain cautious. The reason, though, why we're not seeing red on the screen is even though we did get that drop in same-store sales, it wasn't as big of a decline, Akiko, as the street had been bracing for. But you talk about the fact that consumers are under pressure, they're tightening their budgets, they're not as willing to spend on some of those larger ticket items. And a name like Home Depot, it's going to suffer a bit from the shift that we're seeing in consumer spending.
Yeah, I mean, it's worth noting, again, when you look at Home Depot, Lowe's is right in that camp as well. I mean, they have just seen such an incredible run up over the last 3 years that it's tough to match that when you consider what things are playing out right now. We did hear the retailers saying essentially they're not going to be raising prices anymore, but they are seeing the consumer turn a bit more cautious. To your point, Shauna, maybe delaying some of those big ticket items. The DIY projects aren't happening anymore. That's been the trend for some time now. When you think about the professional builders, you know, they are still going to Home Depot as well, but some of those projects are being delayed out of concerns about rising rates. But also when you think about the home market, that the overall slowdown that we have seen there, that's really hit Home Depot in a way as well. So we're seeing that reflected in the numbers we got today. Now, checking in on the home builder sector, as rising mortgage rates are taking the steam out of the market, sentiment for newly built homes dropped 6 points to 50 in August, according to the National Association of Home Builders. That is the first decline in 7 months and the lowest level we have seen since May, when sentiment first rose out of negative territory. When you think about what's happening in this space, it is very much sort of the similar storylines that we have been watching, Shauna. It is about higher mortgage rates and seeing increasingly sellers remaining on the sidelines. You talk about buyers getting pushed higher in terms of prices because there's not enough inventory there as well. And that's leading to a broader slowdown, even as we see new construction taking shape to increase that inventory.
Yeah, certainly. And we're seeing some of that concern reflected within this index. But when you take a look at the outperformance of so many of these home builders since the start of the year, this is a group of stocks that has really been leading, one of the leaders of this rally. You had Lennar, D.R. Horton among the names that are up just about 40%. So yes, we are seeing some pressure across the industry today, but certainly when you take into account the role that some of these home builders are playing in the current market, Akiko, like you were saying, the fact that inventory is so tight, buyers who are still willing to buy in this higher mortgage rate environment, they're almost left with no choice but to opt for a new home. An application for mortgages to purchase new homes, that rose about 36% from a year ago, as we talk about some of these new homes growing their market share of the homes that are available and on the market right now. And also, in the 13F filings that we got out last night, Berkshire Hathaway, Warren Buffett's company there, disclosing that it added positions, new investments in D.R. Horton, in Lennar, and in NVR. So he, at least over the last couple of months, still sees some runway here for some of these home builders. All right, let's also take a look at shares of Lyft, higher today on news that its CEO David Risher bought 100,000 shares of the company. According to an SEC filing, the executive purchased the shares at $11.46 on Friday, potentially signaling good things to come for the ride share here. We're looking at a gain of nearly 4% in the stock today. And Akiko, the thought here is that an executive, if they go in and they buy the stock, they're very confident that that share price is going to rise. So that's why we're seeing a bit of a movement here to the upside. So we'll see whether or not some of these gains hold, because we know Lyft obviously lags far behind its biggest competitor, its only competitor, Uber, really, within this space, and has much room to improve in order to better compete with Uber.
Yeah, and Lyft needs a bit of that vote of confidence, right? So at least for today, we are seeing shares move higher. You could argue that things are starting to turn around for Lyft as well. Yes, they are not as diversified as Uber, as we like to talk about a lot, in terms of moving outside or expanding their tentacles beyond ride sharing, but we did see a stronger outlook for Q3. Last week when they reported, we also saw the number of active riders increasing, partly because of the aggressive pricing that they have done to try and compete from Uber, and that's brought revenue down, at least the average revenue for riders. But look, they have had a really tough go. It's not just the executive shakeup, it is about the competition with Uber having to have the incentives in place for the drivers, all of that leading to the declines we've seen for the company. So a new CEO coming in and buying 100,000 shares there, certainly at least a vote of confidence for today.
It is helping investor sentiment, at least for today, when it comes to Lyft. All right, well, expectations are high for NVIDIA ahead of its second quarter earnings results next week. Now, this earnings report is going to be the AI hype cycle's biggest test yet, potentially. Here for a deeper dive, we want to bring in Yahoo Finance's Dan Halley. Is it going to live up to those expectations?
That's what analysts seem to think. We have a bunch of different analysts from different Wall Street firms raising their price targets. We have Wells Fargo going from $450 to $500. We have Baird going from $475 to $570. UBS from $475 to $540. These are big changes, and this comes even after NVIDIA had signaled that they were going to outperform for this current quarter revenue. We're looking at let's see here, on the earnings per share, a 306% year-over-year increase. On actual revenue, a 64% jump year-over-year. You remember that the prior anticipated revenue was for $7.2 billion for the quarter, but NVIDIA came out and said, look, we're going to bring in $11 billion, plus or minus 2%. For the quarter. So, they're really going to have to knock it out of the park if they're going to beat this. But it seems like everybody is just saying, sure, it's a shoo-in at this point. That's where the potential negative comes in, because, this is one of the companies that's been driving the AI hype cycle alongside Microsoft, Google, Meta, Amazon. If they miss, and I'm not saying they're going to, I'm just saying if, then it could give the whole AI hype train could kind of derail it for the time being, just for a little bit. The problem that NVIDIA has, if they have any problems at this point, is they can't get as many products out as they want. TSMC just doesn't have capacity at this point. When these companies put in orders, the NVIDIA customers put in orders, it takes some time for those to get out the door. And right now, because so many people are going to NVIDIA, because so many people want to get into AI, they can't match up with what they're offering. So some analysts say, look, they'll eventually catch up in 2024, something along those lines. It's not that big of a deal, but it is something that I think is worth looking at, especially when you say, okay, everybody wants to see the, results of the big hype cycle. Start showing it to me. Microsoft tried to do that a little bit in its most recent earnings, pointing to specific numbers when it comes to AI. Google was like, hey, here's some products that we have out now that are doing it. And Meta's like, hey, we're working on it. So, every company is putting it out there. Apple's just like, it's there. Just don't worry about it. But, when it comes to NVIDIA specifically, they have to show how it's benefiting them. And hopefully for them, they're able to do that. If not, then, like I said, it could derail the hype cycle for a little bit.
Derail the hype cycle. But I mean, Dan, this is a stock that is up more than 200% off of that hype cycle.
Yeah, I mean, this is an absolute runaway. And for NVIDIA, we've kind of talked about this before. They hit the kind of big to-do in tech at just the right time. They did it with crypto. Bottom fell out of that, and happened to fall out of that as well with NVIDIA, where they had inventory problems. They did it with gaming. That's really how they made their bones. They made enough money to go ahead and invest in the AI efforts. And then for years, they've been doing this AI thing. People kind of dismissed it at first, and now it's just paying off big time. We'll just see if they can actually meet this. I think people are expecting them to blow away the $11 billion number. And then what does that mean for the next quarter? Are they going to expect more from that? And then what does that mean for the next year comp, right? Because then it's going to be, okay, well, you went from here to here. What are you going to do next year?
You're going to fall down at some point, but we'll see. The pressure is on.
Yes,
it's safe to say for NVIDIA to deliver on those expectations. All right, Dan Howley, thanks.
Thank you.
All right, coming up, it's been about 1 year since the Inflation Reduction Act came into effect. And while inflation is lower, is the law to thank? We'll discuss that, also the broader implications of the IRA on the other side.
For investors, 2023 has been a year of exceeding expectations. The stock market has rallied, the economy continues to grow, inflation is cooling faster than expected. So in our first Yahoo Finance chart book, each of these themes makes an appearance. But there's also a sense of uneasiness coursing through the 50 charts featured in this collection.
The expected pattern of the Fed balance sheet, it peaked about a year and a half ago, and it's been coming down since because of quantitative tightening. The light blue line is the securities held on the balance sheet. That's QT and QE. The pop there was the Fed putting $300 billion onto their balance sheet to provide liquidities to troubled banks. Once the banking crisis was gone, the market picked up on that immediately. The ramifications now are, you could see the lines back to where it was before the pump, and so now we're on our own.
The late earnings report index basically tracks outlier earnings dates for publicly traded companies with market caps over 250 million. Many of these we've tracked for almost 20 years, and so we, get a signal when they're reporting way outside of that range. And there's academic research that shows if a company significantly delays their earnings report, tends to be that there's bad news that follows in the report, and then the stock goes along with that. And so we aggregate this on a company level, and as you can see for Q3, that metric has ticked up a little bit. And the closer it gets to 100, the more worried we get. The 100 is the benchmark. Anything above 100 means more companies are delaying earnings. Below means companies are a little less uncertain.
This is a theory that goes back to the early 1900s. And it basically says one thing. When the Dow Jones Industrials, the things that make, and the Dow Jones Transports, the things that take, are doing well, and in this case, both at 52-week highs, you have to pay attention to old Dow theory. It proves time and time again we're in a bull market.
We are in a very unique housing cycle. We saw the buyers pull back initially when the interest rates were much higher, but now the buyers, multiple offers are happening, but the supply is not there. So we are in a very unique circumstance, but the inventory clog up, that is holding back the potential for recovery.
The employee retention credit, it was created as part of the CARES Act, and it was designed for smaller businesses who kept their employees on the payroll, who had their business interrupted in 2020, such that they could claw back up to $21,000 per employee when filing their 2020 tax return. That was extended and expanded greatly by the Biden administration. In July, we had more than $30 billion paid out in these income tax credits. They're mostly going to the top 20% of earners in America who are largely taking these proceeds, these taxpayer dollars, and splurging on fancy international travel.
President Biden out in Wisconsin today touting his economic vision on the eve of the Inflation Reduction Act's one-year anniversary.
Since I took office, the private sector has announced more than $3 billion in investments, not million, billion, in investments for wind energy manufacturing in America. And by the way, it's cheaper than fossil fuels, cheaper than fossil fuels. Folks, as I've said for a long time, when I think climate, I think jobs. Not a joke. When I think climate, I think jobs.
That bill marked the largest climate investment in U.S. history and promised to create jobs and lower health care costs. Joining us now is Professor Gernot Wagner, a climate economist at the Columbia Business School. Good to talk to you today. I guess there's two ways to really measure the impact. One is the economic one. The other is what does it actually mean for climate and trying to curb those emissions. So let's start with the economic picture. The president out there touting that. How would you grade year one of the IRA?
Well, we're at the very beginning, right? So too early to assign a grade in many ways. But we just heard it, right? $3 billion, which sounds like a lot, billion with a B. Frankly, we're talking about hundreds of billions of dollars total over 10 years in clean energy investment. And yes, the emphasis is on clean, right? So all of this is good news.
When will we start seeing more of an impact then? I know you're saying that this is obviously a 10-year plan, but is this something when we talk about more job creation, more investment, more of an impact on climate here in the U.S., is that a year or two out?
Yes, is the short answer, right? So yes, it's a 10-year law, and in many ways, okay, this is sort of Econ 101, if you will, but it's about expectations. right? It's about expectations that, yes, you are going to get tax credits, subsidies, if you go in the right direction. There's a 10-year runway, and frankly, a lot of the hope here is that we are subsidizing the learning by doing early on, climbing the learning curve, sliding down the cost curve, and then this is a runaway train. And yes, it runs on clean electricity.
Part of the president's pitch has not necessarily been to those who have been really on board with aggressive investments into climate, whether that's climate tech, whether that's in the EV space. It is about getting those who may have been a little more skeptical on board through incentives. How has he fared on that front? When you think about, at least on a political scale, getting conservative states, especially on board with these incentives, what have we seen on that front?
I think that's exactly the right way to look at this. And there too, frankly, I sound like a cheerleader now, but yes, great news, because basically most of the investments are in Republican states, right? That's where the land is. That's where the solar and the wind is being built. That's where the manufacturing is being built. So yes, right, we might hear from, frankly, Republicans in DC, basically, all of them voted against it. They're perfectly happy showing up to the opening ceremony of the plant in their district, right? So politically, this is a very smart play. And again, it's pointing in the right direction. We are only at the beginning, but it's the beginning of this global clean energy race.
So how is that likely to sort of shift the footprint that we're seeing? I mean, you were in year one. You could argue it hasn't really been even a year when you consider when the incentives started to take shape. But we were talking about EVs earlier, how manufacturing and the priorities to onshore have shifted. When you look at other spaces too, what's been most noticeable for you? And what does that ultimately mean 10 years down the line when you look at that manufacturing footprint?
I mean, the key bit here, so when we talk climate, we often talk tipping points, right? Sort of the negative tipping points. Once this climate train runs away, once the glaciers melt, there's no turning back. In this case, it's tipping points. It's positive tipping points, right? In the sense that if your neighbor gets the solar panels and the heat pump and the induction stove, you realize pretty quickly that that is fundamentally a better technology. It's not about saving the planet so much as, induction stoves are just better. They are newer. They're more modern, right? They're a step in the right direction on all those dimensions. And we see these positive socioeconomic, to use a nerdy term, tipping points. Once you go in that direction, there's no turning back. And at the beginning of this, but we see some of this already, right? EVs are better cars than the internal combustion engine. So it takes a bit more, it takes subsidies to push us, nudge us in this right direction. But once we are going, right? You're not going to go back.
Isn't cost still such a big issue? I mean, you talk about the benefits of this technology, and sure, those who have made the shift to induction stoves and EVs, certainly helping bring down emissions in the long term, but cost is still a big hurdle. Has the IRA done enough to make this more affordable?
No, it hasn't. Not yet. Frankly, because most of those clean energy tax credits and rebates and so on are not even on the books yet. I mean, we talk about it, and yes, they are in the law, but for example, the rules have not been written yet for you to get the tax credit, the rebate, when you purchase your induction stove, your heat pump, upgrade your electric system, weatherproof, weatherize, insulate your home. And the exciting thing, frankly, is that a lot of those investments are already happening, even though the money, frankly, isn't even flowing yet from this law, right? Again, this is sort of this tipping point, the expectations that, wait, that's the way to do it. That's the thing to do. If you want to insulate yourself against the foul smell from the Canadian wildfires, yes, fossil-fueled wildfires, you better insulate your home. You get better windows and so on. And those investments aren't even subsidized yet through the Inflation Reduction Act. It's coming. The law has been passed. But yes, of course, it takes those subsidies in addition to the excitement, the expectations.
Gernot Wagner, professor with the Columbia Business School. It's good to talk to you today. Appreciate the time. Well, coming up, shares of On Holding closing the day in the red on a mixed bag of earnings. The company's co-CEOs joined Yahoo Finance today to break down the quarter. That interview when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement. What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
On-running shares are selling off today after its net sales forecast fell short of the street's expectations. The Swiss athletic company backed by Roger Federer has posted explosive growth this year, with gross profit surging 64% from just a year ago. Co-CEOs Martin Hoffman and Mark Maurer joined Yahoo Finance earlier today to discuss the latest quarter and also what's next. Take a listen.
It's been an amazing quarter. It was the 6th consecutive record quarter that we had. 50% growth, 60% on a currency neutral base. All regions, all channels are growing strongly. Our best gross profit margin since the IPO is 59.5%, more than doubled our adjusted EBITDA compared to last year. Clearly everything above our expectations. We increased our guidance for the rest of the year. We see continued strong demand going into the third quarter. So we are super positive, and we are clearly on track towards our long-term mission of building a company that is set up for durable growth on top line and profitability.
And Mark, I mean, we did see people really digging in on these earnings, especially focusing on the impact of the strong Swiss franc. What are your expectations there, and how long do you expect that to keep really weighing on the earnings picture for you?
I mean, we're focusing on influencing what we can, which is the products that we're creating and the stories that we're telling and how we're reaching the consumers. I think we're very clearly planning with different currency situation for the months to come. It has a stronger top line impact that it has a margin and bottom line impact, because there's a lot of natural hedging happening there. But I think in the end, we're trying to be open with our communication in terms of what we see on the currency situation, and we're focusing on our implied growth and how many products we bring to the market. Again, and to Martin's point, we're extremely happy with where we stand and also how Q3 has started.
Martin, I want to hone in on that consumer a bit. We did see net sales increase 52%, driven by a high-end consumer. Do you think that this wealthier consumer is able to shrug off inflation here?
Yes, we're speaking about end consumer. So it's really the end consumer that is driving the sales. So both our retail partners are seeing very strong sellout numbers. We are seeing very strong sales in our direct channels, be it our e-com channel, but then also our growing own retail network. And of course, there was some cautiousness how the consumer would react in the current macro environment. We clearly see a bit of a stronger impact of that environment in Europe compared to the US. But as Mark just said, the brand is strong. We have an exciting pipeline of new products coming. We just launched, for example, the Cloudboom Echo 3, our fastest product yet. And this gives us the confidence that is reflected in the numbers.
And I do want to talk about where consumers are getting your products. Direct to consumer, still a majority of your business, but you are, dipping into retail partners. We see a heavy partnership with Foot Locker. Where do you see these points of access really increasing awareness for on running and driving sales?
Yeah, for us, it's always been important to reach the right consumers through the respective retail partners, right? So Dick's is reaching a different consumer than, for example, JD or Foot Locker is reaching, or Fleet Feet as Run Specialty is reaching. And we're really seeing across geography. So whether it's Europe, whether it's Asia Pacific, whether it's the US, very strong growth rates in wholesale and in D2C. And it's in all wholesale channels. So we don't have a channel that is not growing or growing much, much slower. So it's very consistent. And this also then shows that we're tapping in new, younger consumer segments with, for example, Foot Locker and JD, and that strategy is working out. But at the same time, we're the fastest growing brand at Fleet Feet, and we can significantly expand our market share in the running category. And this comes in an overall environment where we have a lot of price pressure from other brands. There's a lot of discounting happening in the market because of overstock situations at some retailers with products from other brands, and we're very happy that we continue to perform super strongly against that, and we can drive full price premium sales. This shows in the highest gross profit margin ever. And we already mentioned it, D2C share continues to grow. which is important because it's our direct access to the end consumers, where we can bring our full product range to life.
And Martin, as we talk about the product range, you mentioned the Cloud Boom Echo 3. Talk about what the success of that model has done for you and what it means for sort of future innovation and the demographics that you're targeting.
Yeah, if you look at running, you basically have runners like myself who are everyday runners, but then you have a lot of athletes who are really going for the best possible time. And the Cloud Boom Echo 3 is constructed and built for those fast runners, especially on the mid to long distance. It has been developed together with our amazing athletes who are now also ready to go to Budapest and compete on the biggest stages there. It provides a lot of new innovations, a super strong helium foam, carbon plate in there. And we expect that this is elevating our presence and market share on the marathons of the world. And then it's trickling down into the everyday consumer, where we have already very strong franchises like the Cloud Monster, like the recently Cloud Surfer, and to grow our market share there. And I think that's the reason why we are currently the fastest growing brand in run specialty as well.
I want to talk about that trickle-down effect. I couldn't help but notice this morning on my commute to Manhattan, I saw someone wearing your shoes on the way to work. When you think about, the different range that you're now getting in terms of ages and, how they're wearing your shoes, even for the everyday wear, what does this mean for future growth plans for the business? Are we going to see a broader audience in years to come?
Yeah, I think it shows that On is a premium sportswear brand that is rooted in performance and rooted in innovation. And this really allows us to have product like the Cloud Boom Echo, very much rooted in running and the performance core of it. But then it's being adopted by people that are wearing it all day and every day. And you can also even actually run to work with the product, or you walk to work with the product. And so for some people, performance means fast times and a carbon plate or whatever. For other people, it means comfort. And I think this is how we're bringing some of these elements into many different products, also on the apparel side. So we're seeing very strong growth in our apparel range. We're seeing apparel growing especially strong around in our own stores, and that shows the potential that the brand has that goes way beyond the core running segment and is much broader than that.
And certainly you have tennis legend Roger Federer as agreeing to become one of your global ambassadors there. So for the non-runner who is looking at your brand and trying to see the appeal here, what would you tell them?
It's an innovation brand with a great design language. Also, if you focus on sustainability, we have fully recyclable and circular products in our range. But all of them, as Mark just mentioned, they give you access to the outsole technology that allows the best runners to perform, but it also allows you to enjoy every day on your feet.
And I do quickly, want to ask, I couldn't help but notice on your site that there's an opportunity to buy last season's items, whether it's apparel, footwear, even socks, ranging from 20% to 50%. But the catch, you need to be an account member. How does this help get rid of inventory, drive sales, and boost loyalty here?
The first thing is great to notice because it shows that we're gaining and attracting more consumers, that more visitors are kind of seeing our website on.com every single year. We already have the same logic for many years actually. But because On is getting bigger, more people notice. And it's a very normal thing. We have product life cycles. We have products that go out of line as we're updating apparel, as we're updating footwear. And this summer, we ran the Classics campaign where basically you have product that goes out of line, accessible at lower rates. And we're trying to bring that to our most loyal customers, also being able to bring the value proposition from On to you when you not shop. And this is why that you're part of the environment is very important for us and beneficial for you as a consumer.
That was On Running's co-CEOs Martin Hoffman and Mark Maurer, as well as Yahoo Finance's Rochelle Akufo and Brooke De Palma. Well, coming up, we are checking in on some of the top trending stories of the day. As always, Ali Canal and Josh Schaefer standing by with what to watch. Guys?
Hi, Kiko. Well, Kava shares, they are up more than 3% after the company reported its first earnings as a publicly traded company. And Josh, there's a lot to chew on in this report, no pun intended.
There certainly is, and they did two things that rival Sweetgreen couldn't accomplish this quarter. We're going to bring those to you next.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined today by Brooke DePalma and Josh Schaefer. And we're watching Kava earnings. They seem like they reported very strong results after that much hyped IPO. I know, Brooke, you've been following this company very closely. What's the latest here?
Yeah, big story here. Record levels of profitability and revenue for the Mediterranean fast casual chain. Here's really what you need to know. Revenue coming in, as you could see there, to $172.9 million. That's compared to $105.3 million in the year prior. Net income here reported of $6.5 million. Now that's compared to a net loss of $8.2 million in the prior year. Shares here jumping in after hours trading off of these results. And in addition to that, same store sales, really a big winner here, up 18.2% for the quarter at Kava, driven by higher menu prices as well as traffic growth. We saw traffic growth in the last quarter up 10%. And so Kava really perhaps making headway here in a different IPO story than what we've seen in the past. Of course, their competitors, as you mentioned before, Sweetgreen, Chipotle, as well as other fast casual chains. They also have net new openings that are also driving awareness as well as growth. And investors really seem to be liking these results here.
Yeah, Brooke, it's not necessarily like an entirely fair comp because the companies are at a little bit of different stages, right? But if you pull up that Kava earnings again and you take a look at some of those numbers, I mean, you look at Kava's revenue compared to what Sweetgreen posted in the quarter. So Kava revenue at $172 million. Sweetgreen had revenue of $152 million in the same quarter. Kava positive EPS of 21 cents. Sweetgreen negative EPS of 24 cents. At some point, you're looking at two similar companies, right? They're probably attracting a relatively similar customer, people like us in the city going and looking for lunch.
We went yesterday.
Maybe someone going for dinner. We did go to Kava yesterday. I do want to talk about my bowl. But I think overall, you see Kava growing that top line. I mean, that's what you want to see out of this company, a company that just IPO'd. You want to see surprise to the upside when it comes to revenue, when it comes to sales.
Yeah, and I mean, that same store sales beat 18%. That is significant. And I remember Chipotle, which broke a couple weeks ago, they missed on that same store sale estimate. And that contributed to a stock loss at the end of the day. So I feel like that's increasingly important with a lot of these fast casual chains. We'll see if that momentum can continue, because I know, Josh, you and I, we were debriefing after our Kava experience.
Long line.
Boots on the ground reporting. There was not a long line, but I wouldn't say that was the biggest take. Yeah.
I was very stressed in line. There are so many different options. I wasn't sure what I wanted. I just picked a bunch of stuff, probably over committed on the ingredients. Well, that was something that you brought up.
Well, they opened 16 new stores in the last quarter, and I'm just curious how many new stores you can open in similar areas and sort of overpack a city like New York, or are you just going to expand into other areas where you aren't? Because personally, I felt after eating the food, it was good. It was a little filling for lunch.
Heavy.
And it's a different kind of spicy that I don't know if I'm having once a week.
Right.
Or more than once a week, right? Is probably ideally what they want. And they have a variety of flavors, but it's just so different for me that I don't know if I'm going to keep going back. on a consistent basis. So like when you think about the long-term trajectory, that's something that interests me.
Well, let me tell you this. So right now, diving into new and existing markets is certainly a key strategy for them. And based upon what they're saying here, their full year 2023 outlook, they expect to open between 65 to 70 new locations this year. So, that's a pretty substantial jump, a pretty substantial long-term growth strategy. They also plan to open thousands in the next decade. And so really what they're trying to get here is that consumer that maybe hasn't had this before. And a lot of analysts on the street are ultimately comparing it to Chipotle, where there was, an untapped potential for a Mexican fast casual chain. I almost said Sweet Green, Cava, really looking to do the same here, really lean into that untapped potential, perhaps in new markets as well.
Yeah, and the Cava bowl, for my bowl at least, was $20. I thought was,
what did you add, Allie?
She added
double
avocado.
protein, add the avocado.
I think there was two different kinds of meat.
Mine averages out about 30.
I want half
13.
chicken, half spicy lamb, but I didn't do a
but
double.
those both costed more.
No, I think that double
They costed more. I was paying attention on purpose. They definitely both cost
my
more.
bowl is $20.
I just got chicken and it was $15.
I know,
Right. Yeah, mine averages like $13.
I have like a lot of stuff in my bowl, but it made me think about the inflation picture overall because it's interesting now. I know you closely watch the food index and the CPI print, and dining out, it's been coming down, but at a much slower pace than grocery. And what's interesting is that these grocery chains now are competing with restaurants, especially with their prepared food sections. And I support the Whole Foods prepared food line. I mean, you can get some good stuff there, and probably at a much cheaper cost than if you went out to
you can get
a
it
restaurant.
from a lot of places for like $12 or $13, which at some point, like, time cost of money to just not cook for the 30 minutes or hour where you also clean. Like $12 or $13 ain't bad for dinner these days. So like I think a lot of people are looking at that option. You wonder how the grocery stores are going to sort of build that out, right, and continue to do that.
We're certainly seeing food prices away from home jump higher year over year than food prices at home. And as you noted, on the fast food side of things, these companies are really trying to introduce limited time offerings, innovation. We saw Taco Bell out with testing 2 new chicken options today. So really looking to bring in consumers based on these limited time offerings or these new items, as consumers have to make that choice about where they're going to get the best value.
Well, there's 2 things that I'm always spending money on. That's food, and that's also streaming services.
Absolutely.
To my next topic, because there's been a lot of talk right now. It's been dubbed streamflation, how it's really rivaling the cable bundle at this point, which is a story that we've been following for quite some time. And it comes on the heels of Disney announcing a lot of price hikes. And there's a new report from Nielsen that showed linear television viewership, so that traditional viewership on cable and broadcast, that actually declined below 50% for the first time ever. So we're at the point where linear TV, it seems like we've reached a point of no return. That's according to an analyst note that I was reading earlier today. So there's a lot to digest here when it comes to where media is going. Streaming services obviously seems to be the next frontier, but even there, we saw a significant loss of subscribers among some of the top streaming services like Disney Plus, like Max. Now, a lot of that was because of these rebrands. But we just seem to be at this critical juncture when it comes to.
Well, it's interesting you say critical juncture because it was Tim Nall, the analyst that you were quoting, and he also pointed out, okay, so we've known this trend for a while. Who's actually well positioned in it? And you think about like what's the trade, right? And he pointed out Comcast and their Peacock service. He said about 85% of Comcast's revenue is still coming from the linear cable side. That just doesn't feel good when you think long term about these trends, right? If people are moving away from linear cable, to be positioned that way seems pretty interesting.
And Disney's the opposite.
Then you look at Disney and it's the opposite. And Disney thinks that they're going to have more money from the streaming side, the D2C side, than they are the linear side. Remember Bob Iger teasing out that they might even want to get rid of that linear side.
And to clarify, that's DTC ad revenue.
Right.
DTC is still struggling overall with profitability, but ad revenue, interestingly enough,
so to drive ad
side,
revenue from the streaming side, I think is pretty interesting to be able to see who's sort of positioning themselves well there. But then how do you keep subscribers coming in? There's so many questions that build with it.
And another thing, too, is right now we see the average household holds about 4 streaming services, if I read that right. That averages about $30. And really with this new take from Netflix, really cracking down on password sharing, I know I'm certainly sort of refiguring what I want to pay, what I don't necessarily want to pay, because I do want Netflix back. I'll admit, I was one of those people. And so really here, when I think about Max, we were talking before, but I only got it to watch, and just like that, the Sex and the City reprise. And so really sort of re-strategizing, rethinking my budgeting on how exactly and where I'm willing to spend.
Yeah, and the password sharing correct on that you mentioned, Netflix saw a rise in subscribers, 5.9 million subs added in the quarter. I think more to come on that too.
I've been watching Suits on Netflix.
Suits is making a comeback. It's a classic Netflix effect.
But I think that gets to the story we're talking about in the sense of why linear TV is still dropping.
Right.
Because you can take a show that I didn't know existed over the last decade, resurface it, put it at the top of the page, make it look fresh, and I'm watching it, and all of a sudden I'm like, wait, is that Meghan Markle? Like the Meghan Markle I watched a documentary about?
Versus a completely new show.
Yeah.
Just a completely different narrative that's ultimately
it keeps people paying for Netflix.
Exactly.
Very smart.
It's interesting too because during the writer's strike, CBS is airing old episodes of Yellowstone on CBS. So you wonder if maybe that could be, even once the writer's strike hopefully gets resolved, if that could be an opportunity for some of these media giants that do have exposure on the linear side. But, you know, certainly there's a lot to navigate right now when it comes to these services. Yeah. All right. Well, I'm going to be going home and streaming Suits because he says it's really good.
I might have to rejoin Netflix to do the same.
But speaking of streaming, we're still streaming here on Yahoo Finance Live. Stay tuned. There's a lot coming up on the other side of this break.
I think they would both fold in 5 seconds. I feel like Mark would bring some moves, but in the end, Elon would beat him.
It may be wise to have some sort of contingency plan.
I'll take Elon.
We no need to rush, you know. Look, what's the hurry?
Definitely Mark Zuckerberg. He seems like someone who would go a little crazy and beat Elon Musk up, and Elon Musk is like all talk. It would be embarrassing for him, I think.
I think that's gotta be true.
I think Mark may have the skills.
I do think it's going to be very interesting to see how this plays out.
I'll put my money on Elon, though, because I feel like he's a little crazier.
Oh, wait a second. That's the exact opposite.
People say that Mark Zuckerberg actually does like some form of martial arts.
I like jiu-jitsu. I also really like MMA. We have like a mini academy in my garage.
So I guess my money's on him.
It's awesome. I got like a ton of my friends into it.
I don't care.
I don't know. I think Elon Musk probably.
You know, hopefully this can serve as an inspiration for excitement about the future.
I think if they both managed to kill each other, the world would win.
It is closing time on Yahoo Finance. Here's a look at some of the top stories of the day. The National Association of Home Builders reporting sentiment dipped in July, snapping a 7-month streak of gains. Rising mortgage rates and inflation are to blame. The NAHB also noting that higher construction costs weighed on builders. Mortgage rates are back near 7%, and we're going to get the latest data from Freddie Mac on Thursday. On Wall Street, shares of VinFast soaring in its market debut. The Vietnamese electric vehicle maker closed above $34 a share after opening at $22. At these levels, the company has a bigger market cap than Ford and General Motors. VinFast CEO Thuy Le telling Yahoo Finance in the last hour about its plan to build vehicles in the U.S. and sell them here, saying there is a lot of opportunity here. And finally, another day, another discount for Tesla. The car maker launching cheaper versions of its Model S and Model X vehicles. Each are $10,000 cheaper than their previous versions, but they'll have shorter ranges and will be available for delivery between September and October.
And what to watch on Wednesday. First up, Target is set to report its quarterly results before the opening bell. Target sales could take a hit from consumers pulling back on discretionary spending. Analysts expecting the retail giant to report earnings of $1.40 a share. We'll also get a look at the consumer when TJX releases its results. Analysts will be closely watching sales at home goods. The segment there disappointed the street last quarter. And Cisco is set to report earnings after the closing bell. The results will give the street a better look at IT spending and how much companies are willing to spend on technology infrastructure. And on the economic front, housing starts expected to climb roughly 1% in July. Now, this would follow an 8% drop in June. And the Fed is also in focus with the release of the FOMC minutes from its July meeting. Investors will be paying close attention for any insights on the central bank's move forward here, their path forward for rates. Well, that does it for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you right back here again tomorrow.